Future Generation is celebrating its 10th anniversary this month. That's 10 years of investing and $44 million donated to Australian charities and philanthropic institutions over the past decade. The Future Gen runs to LICs which donate 1% of assets to youth-focused charities. Well, earlier Juliet caught up with Nikki Thomas of Magellan Financial Group to discuss why the company supports Future Gen.
Magellan's been a supporter since the very inception of Future Gen, one of the major funds behind the Future Generation product, the Future Generation Global product. And, I think in the early days, Hamish saw this as a great opportunity for Magellan to support charities while doing what Magellan does best, and that is looking after people as well.
And what have you seen in terms of, the change over the last 10 years? What sort of value do you see created here?
Yeah, look, I think Caroline does an incredible job of connecting really important charities and really important causes, and at the same time all the fund managers that they use to look after the product. So she brings people together, she creates real connection and understanding of what the purpose of Future Gen is, and they've raised enormous amounts of money and then done a lot of hard work to make sure they deploy that really well.
When we look at investment strategies, how do you sort of change or look at your investment strategy when you're working with Future Generation?
So they are invested into the same strategy that we run for all of our clients. So nothing different in the way we go about managing the money, and that is that it's a high conviction strategy, it's high quality companies, it's looking for long-term compound returns, and we run the strategy with a view to minimum volatility. So trying to create a nice compound, lower volatility return for clients as we go through this. So yeah, it's all about good businesses that are really advantaged.
And speaking of volatility, it's a very volatile time in markets now, particularly with the US election underway. How are you navigating all of that and viewing the overall macro picture?
Yeah, look, I think there's been a lot of positioning going on in markets at the moment. As we've gone through the last couple of months, everybody looks at the punting markets and are like, oh, it's a Harris win, let's buy these stocks, and then they change their mind and they buy other stocks. To be honest, that is classic noise. It is not what we should be doing as investors. We should be looking through that noise and trying to find where the real opportunities are. So the only things we're really thinking about with this election is what long-term changes could the governments of the US bring, depending on who's in charge, what policy could get through, and how will that influence companies that we want to be invested in.
So how are you looking with that in mind then? How is your verdict, particularly now we have some of these big Mag 7 earnings out of the way as well?
Yeah, so we've just got through a lot of reporting season, and I would say, in our portfolio we have quite a number of the Mag 7, these big, incredibly advantaged companies that are leading the charge on AI. The results we saw from those companies were extraordinary. We're talking really strong growth and incredible operating profit achievements. They continue to grow backlogs enormously. So we're talking over the last 2 years, revenue backlogs for the sort of hyperscalers is up about 150 billion. At the same time, their capex plans are up about 90 billion. So this is an opportunity that they see in front of them that is going to change the way we work, change the way we interact as humans, and they want to lead that charge. So there's a lot of short-term noise around things like what's happening in semiconductors, and are we going to see some slowdown around autos in the short term? But the underlying trends are extraordinarily strong, and in fact we've gone from a period where there was an optimization around cloud for a period of time, and we're now coming out the other side of that, and we're seeing that re-acceleration as companies think about their IT budgets and think about the opportunity that lies in front of them for productivity and moving their workloads into the cloud, and we're seeing that re-acceleration. And those big tech companies went after costs during that difficult period, so they're doing it now with leaner capital and cost structures. So we feel pretty convinced that these businesses, if you're taking a long-term view, which is what we do, are going to be really advantaged as we move through this big change.
Now, another one of your holdings in your global fund is Chipotle. What does that tell us when we saw that poor result about the strength, the health of the US consumer and the inflationary impact here too?
Yeah, so I'm going to correct you a second. This is classic stuff in markets. People see a share price fall and they assume something's wrong. Actually, the share price really fell on no major news, and the result itself was extraordinary. So this business delivered comparable store sales growth in the quarter of 6%. It delivered 34% increase in earnings. the reason why there was a little wobble was that they said instead of opening at around 10% growth rate on space next year, it might be about 9.5%. They've just been a little bit careful because they're seeing a continued hold back in getting those regulatory approvals for new store openings. But this is a business that delivers under 2-year cash on cash paybacks. It's growing space in the US at a rate of 8 to 10% per annum. And we're talking for as far as the eye can see. It has 3,600 stores today and it's aiming for 7,000. That's not taking account of any of the opportunity they have outside of the US. And when you're delivering those sorts of returns on capital, that sort of cash that blows off, this has no debt. It's a cash positive business growing. We would expect at least 20% per annum over the next 5 years compound. Extraordinary investment, extraordinary stock to own. So we're delighted with the results we saw.
All right, let's talk about Europe and whether or not you're considering exposure there at the moment compared, I guess, to what you're seeing in the US as well.
Yeah, so look, I think there's a tendency sometimes in markets for people to look at PEs, terrible measure. If PEs told us the truth, none of us would have jobs, and says, Europe looks cheap. So Europe's mostly old economy, whereas the US has much more of the new economy stocks. Returns on capital in Europe are often quite challenged, whereas they're very strong in the US. If you compare just the last 5 years, the S&P 500 has risen 85%. The stock 600, so the European index, has risen 25%. So that's why it looks cheaper. It's actually that the economy is more challenged, the opportunity is more challenged. And Europe had advantages because they used to get cheap gas from Russia and they don't really get that anymore. And at the same time, China's, through the Made in China 2025 policy, has gone after that industrial complex that was Europe's original ground of strength. So you've got cost competitiveness coming down, and Europe, unless you're selling history, which it does very well, it's really a much more difficult environment for Europe looking forward. So we buy a lot of multinational companies. We love businesses that are globally diverse and are advantaged when you think about them on a global scale. So, Netflix might be US listed, but it has a big European business. Microsoft similarly has a big European business. We own SAP, which is European listed, but it has a massive business outside of Europe. So we're just trying to find the best companies within great industries to lean in on and get that compound growth going.
So once we get the US election firmly out of the way and we're looking ahead, of course, to more rate cuts coming through from central banks globally, what are the key drivers in your view for 2025?
Yeah, look, I think 2025 at a market level is hard to call. It's kind of not what we do. We look under the hood and try and find great opportunities within that. So if I think about our portfolio, the opportunity for us as we look forward is that policy rates are likely to come down a little bit further. So that should be a bit of a tailwind. We're not optimistic that long-term rates will come down much, but they'll probably stay around where they are. And so the real drivers for our businesses that we're always looking for is that compound growth in earnings and cash flows, those really strong fundamentals that drive businesses over time. And so they're the sort of things that we think will be very positive for investors as we look out to 2025.